Brian, how are you today?
I am well, Ryan. How are you doing?
I think I want to ask you if you could repeat what you the comment you said. I said you've been on your toes, and I said, "How's my favorite economist?" And you said, "What was your response?"
I don't remember exactly. It's just this economy is having fun with me right now.
Oh,
it is tearing
man.
me up, man.
So yeah, I was just gonna say, like, since the last time we talked, I thought we had a lot to talk about last time, and we've had a couple banks that have been in the news. We've been keeping ourselves busy. So I'm trying to think of how do you even want to start. I'm trying to think of what the banking sector I know has been in turmoil since we had a conversation last. And I was just letting you know, I picked up and consumed both your books again since we talked last. So I've got your material hot off the press in my mind. But maybe kind of starting from kind of your guys' thoughts as far as maybe like with the banking sector. How do you want to start there, or any place in particular you want to pull the thread?
Yeah, I think the banking sector is a logical place to start. I mean, we had 3 banks fail now, and all 3 of them had something in common, and that is they were very focused in terms of who they lent money to. They were all had very high percentages in terms of deposits that were not FDIC covered, and they were all very called bond banks. I mean, because their loan portfolio was so low, they overinvested in bonds. Interest rates go up, and as Buffett once said, "There's nothing like the tide going out to find out who's swimming without a bathing suit." So now we know who is swimming without a bathing suit. We have an economist on staff that used to work at the Fed. So she's gotten some really good data that I didn't even know existed. And the good news there is the really bad banks like SVB and First Republic, they're a very small minority. And you get into some pretty healthy looking banks pretty quickly by a couple of different metrics, which is really encouraging. But 2 things are uppermost in our mind, though, when it comes to the banks. One, even before the banking issues, credit conditions are already tightening. Now these small regional banks, there's a comma there, are tightening up lending even more, particularly as their stock prices crash. They tend to go hand in hand. And that's going to make things more difficult for people who didn't look out ahead and make sure that their line of credit was already where it needed to be. They didn't take our advice and assess their cash flow and what their cash needs were going to be. They should have been doing that 6 months ago, but not everybody did, obviously. So there's going to be some businesses caught up short, and that could be your supplier, it could be your customer, it could be you. Either way, it's not going to be pleasant.
Well, and we can see that inside of our clients, Brian, with the demand and revenue. And I love it how you guys had, like, the way you guys worded it in the book was see the future before it hits your income statement. I'm like, oh my God, is that just the most beautiful statement ever? And you guys were talking about in I think it was in the B cycle and then the C one of like where you want to start looking at when like lending's more flexible with lower rates, and using your cash to be able to anticipate the C and D cycles, but obviously preserving your balance sheet and your cash flow statement. But I want to go before we kind of go into the cycles and the different sectors, Brian, is what I found super fascinating about the SVB bank and these banks is the when they have the mismatch of their short-term versus the long-term investments. Can you maybe help the audience better understand that? Because and the reason I'm asking about this, Brian, is I think about how that mismatch of like someone having that many bonds that aren't yielding that much and they don't have liquidity. And I think about real estate, commercial real estate. And then I also think about private equity, but we don't see those in the news because they're not as public. And I feel like it's the same kind of mismatch potentially that's kind of underneath there. And I don't want to think that if it's, out of warrant, if it's not warranted, but I'm kind of just maybe explaining kind of the mismatch. I think people understand that would be very helpful.
The mismatch was, and it was accurately described at the time, it was a bad business plan, poorly executed. That explains that. You mentioned commercial real estate, and that was the second nugget I was going to bring up in connection with the banks. We're looking at the vacancy rates very, very carefully in different slices of commercial real estate. And the other one that worries us right now is office space. We have not gone back into the office.
Mm-hmm.
And you see it, San Francisco is the worst case, right? And we're going to see it in parts of Manhattan and other major cities in the northern part of our country.
And Brian, I saw the San Francisco bank, or not San Francisco bank, the San Francisco article about that one building that was valued at like 300 million. Now it's going for auction for 60 million. And same week that I saw, because I'm in Minnesota here, the IDS tower, I saw the numbers on that one. I was like, oh my God, I can't even imagine being the person responsible for trying to refi that loan with the revenues that aren't there. And I don't know if they took a margin loan against it, but the equity just disappeared on that thing in like 4 years.
Oh, yeah. And the banks are going to get stuck holding those keys, right? What are they going to do with them? They're going to have a fire sale, and there's going to be some major haircuts being taken. Fortunately, it isn't every city, and it is mainly the northern cities or the high-tech cities, and you qualify for both.
Yay.
Yeah.
That's not something I want to qualify for both in, I don't think.
But I was looking at retail vacancies. I thought I'd find some pain in the retail vacancy rates. Surprisingly not.
Isn't that crazy? What is that, just because of the flood to the suburbs, or you're talking about even in the cities too? The retail.
I didn't break it down. I just looked at national numbers, so I didn't break it down suburban or urban. I was just, I got enough. I don't need to go looking for trouble, Ryan. Thank you very much. For offices, the vacancy rate right now is at 10.7%. That's the fourth quarter. That's the latest available number. In the third quarter, it was 10.8%. So it has come down a little bit. But you've seen the articles and the numbers. There's this great wall of refinancing that's going to have to happen in 23, 24, and it's going to get dicey out there. If people ask me, as they occasionally do, should I be buying some commercial real estate? I say, well, you got to define that a whole lot better if you want an answer. And you got to tell me the geographic market you're talking about too.
Nuances matter in this particular case.
Yeah. They kind of do.
So when we talk about I look at the equity of like what these balance sheets, whether it's commercial real estate investors or the REITs or the banks, going back to even Silicon Valley Bank, where like they're looking at where they don't have enough liquidity. And then as they're forced to refinance, their cash flow is going to be strapped even more with the debt and whatever. I don't know. My head starts to hurt, actually. I just start to think about it. And then that's why then I just pick up your book and go, now I've got the manual to figure out how to navigate the waters. But
it is, there's going to be some big time pain out there. A friend of mine, though, is really big into the medical properties. They're doing great. They're fine. Cash flow's amazing. It really is so far relegated to office space. And when I ran the numbers, because I'm a nerd, and the office space amounted to about 14% of total private commercial. So It's not like it's the lion's share of it. So I recite those numbers to myself at night when I start to hyperventilate.
Thank you. That was exactly why I wanted you on. I'm like, okay, I can worry a little bit less. And as you kind of like pull that thread, the banks holding those, are they more community banks or more the bigger banks like JP Morgan?
No, it's not the bigger banks. They never got into that. It's 70% of that mortgage money is with regional or smaller banks. That was their purview. A friend of mine was thinking maybe the life insurance companies were involved, but they only own 9% of those mortgages. So it really is the banks that are going to be.
Yeah, and those are the banks that aren't looking, as you said, they're tightening up and they're not lending as much. They're the ones that are looking at the cost of deposits being a little bit more, well.
They got to move up those. That's a very good point, though. I mean, if they were to move up those deposit rates, they'd be doing themselves a big favor instead of running so far down that who wants to have any money in there, right?
I had one of my business owner friends call me up, Brian, and this person that they knew that actually started their own bank, like it was like a couple years ago, and then called them up asking for deposits. It's like, woo. So it's like, I mean, obviously there's a a major desire to get those in for the ratios that they need. And so as I think about, you know, covering commercial real estate, I get it. Like as we then go into like the cycles, I want to start introducing to the audience more and more to the cycles and as you look at the different industries and where they might be in, because I listened to your guys' segment. I believe it was about, I don't know if it was the one on the commercial real estate, but you are also talking about where industrial manufacturing was going. And this is all tied into what I want to continue to pull out of these quarterly episodes with you is like, what can we be doing about it? And you guys have some amazing, like practical tactics in the book about how to be, adjusting accordingly your prices, your contracts and all that kind of stuff. So maybe like kind of just give us an overview again of the cycles for the listeners. I'm going to be beating in their head to go pick up your guys' books, but then any noticeable sectors or industries that are changing that you guys might be
Yeah.
keeping an eye on?
The business cycle, we break it down into 4 phases: A, B, C, and D, because we're very clever economists. We went with A, B, C, and D. And an example of a phase A, that's when the rate of change has reached its low. So the numbers are getting less and less negative as each month passes by. And the trailing 12 months begins to rise also. And the best example of that is going to be within about 1-2 quarters, private residential construction. We're seeing some early signs of life in permitting and in traffic. So we're reaching the bottom over the next 3 to 6 months, and that'll be in phase A for a good portion of 2024. We have a very mild climb over the course of 24, 25 in that space. I know some of the major home builders are thinking it's going to really take off. And I'm thinking they must be looking at different data than I am, because when you look at how many mortgages are in the pocket of these homeowners below 4.5%, where's their incentive to
All right.
to do anything, right? I mean,
right. My dad is actually looking for a house right now, Brian. And I'm like, the people that you're trying to buy their house for, they would sell their house and buy a house half the price, just at the same monthly payment. So like, there's no incentive for people to get the heck out of their house at all.
nope. And this is going to be a whole cultural shift too, by the way. This is a sidebar. The younger millennials are going to have to realize that their first home isn't going to be what you and I had for a second home or a third home. They're going to go back to buying starter homes. But when I mention that to younger people, what I invariably get is, shut up. Oh, no, really, you're going to have to shut up. I'm not going to get an 1,800 square foot home. Hey, dude, that's pretty big for a starter home.
Yeah, well, you know what? They can go ahead and do that and then end up on Dave Ramsey, like that couple that went viral. Did you see that video?
No.
It was like two months ago. This couple calls into Dave Ramsey. There was like 6 million views on this thing, and they were like 31 years old, and they were almost $1 million in debt between student. Oh, I know. You should have seen Dave Ramsey's face. He's like, "Wait, how much? How much is a mortgage?" And they were like 230. He's like, what the hell else is there? So yeah, like, and he's like, I'm going to put you on a budget of a $30,000 budget between the two of you. So, I mean, you can end up like them, or you can actually swallow reality, right?
So they're the opposite of what you should be doing with housing beginning to come around. And they're in phase A. You asked about the different phases. Non-residential construction, new construction, that's in phase B. That's still climbing up at an accelerating pace because it lags housing by 2 years. Mm. And then you have GDP and industrial activity, and they're in phase C, slowing growth. They are still growing, but the rate of rise is slowing. And then eventually they're going to get into phase D, as will the automobile industry by early 2024. And that's where you're in active recession, that you're running below year-ago levels. And that's where housing is today, and we're waiting for it to stop with the D already and get up into.
And that's where it hits the lowest negative, and it starts to climb back up to then to zero. Yeah. And when I thought was so awesome about, like, when I was going through the chapters of these books about like tactics and strategies to apply as you're, when you mentioned even like when you're getting into phase A, like how the pessimism and the dark clouds are still there, but yet if you look at the data, you should start making moves. Hence the title of one of your other books, right? And so What I thought was very interesting about, like, specifically because the inflation in your chapter about how, this is a generation that hasn't seen inflation, me being one of them. I mean, I've done a lot of my own education, but it's only out of, history, not like, oh, not, obviously now I'm experiencing it, but some of the strategies you guys were talking about of like how to like maybe there's one particular one I think it was the CPI, or there was a couple of the different indexes about when you're locking in contracts versus when you're working with your suppliers, kind of
Yeah, yeah,
the
yeah.
mismatch. You want to maybe explain that for the listeners, because it's a really really interesting strategy that I think if you have this data that you guys are pushing out, you can make major moves that are
Oh
going to
yeah,
change.
inflation can be profitable if you play the numbers right. One uh, facet though is you must have a competitive advantage. If you're just a commoditized product or service, then there isn't a whole lot you can do, but you can still do what you were alluding to. It's based on the fact that the CPI, well, it's going to go up. It doesn't go up as high as the producer price index. Okay. So you get your supplier to commit to the consumer price index as a price inflator, and you get your customers to commit to a producer price index. So you
I
get the
love
added
it so
margin.
much. Which is like, I think in that example, you guys was like what, 3% difference or close to
Yeah.
five or what the heck it was. So like you got a solid spread there between the two.
Yeah. And these days, clients, business people are smart to add in a labor price index because commodities can go up, commodities can go down, but your labor is going to be rather relentless. So build in a labor price index.
So that labor price index too, I want to pull that thread because you guys in the book you were in, it was a well articulated of the difference between like the just the printing inflation that I'd say the masses are obviously aware of because of how much money has been printing, the money supply going up. But then you were talking about sticky inflation, that the fire that just doesn't stop burning, which has a lot to do with labor growth. Can you explain what you mean by like the quick inflation versus the sticky inflation and why it's sticky? And then I want to go into then how you guys are talking about how to deal with labor. And I'm looking at the clock too, making sure we're good.
Okay. Um, what we're going through is an excellent example, Ryan. The Federal Reserve created all this inflation along with the Congress by giving out all the free money, and the Federal Reserve obliged them by creating all these I's and O's and ones and zeros and creating all this funny money, right? And voila, you increase demand and you're going to get inflation. So now we have the money supply actively coming down and has been coming down, um, going on a year now, because they're trying to clean up their own mess. And that's why the economy is slowing down. That's why people are dipping into their savings. That's why the $1 million remodeling projects are going on, but the $50,000 remodeling projects aren't going on. Okay.
Well said.
So that's the part that they can easily control. What they're also bashing their head against the wall about right now is they're trying to bring down the cost of labor. Now, I don't know if you've seen their pictures, but none of them, I don't think, are going to be in a position to procreate that quickly. That they're going to add people to the labor supply,
Just
right?
randomly had about like 80 million skilled millennials to be sitting there for
Yeah,
computer
yeah,
science and aerospace engineering degrees, right?
yeah. So what they're trying to do is they're going slowing down the demand for labor by putting the economy into this recession, but it's only going to be temporary. Unless they're going to keep us permanently in a recession, we are going to rebound. We're going to start wanting to hire more people. In fact, even with all the squeezing that they've been doing, the unemployment rate remains ridiculously low. It's just job openings have come down. Companies are
Mm-hmm.
using attrition to slim down their workforce, but the high tech headlines on layoffs. That's a very small nut in the
Mm-hmm.
universe, but it gets a lot of people excited, anyways. The bottom line is, if you need a body in your warehouse, or you need somebody on that truck, or you need somebody wearing that pair of boots to get the job done, they're darn difficult to find, and you're likely going to keep paying them.
Well, going back to how you layer on these decisions with the cycles too, when you were talking about how ramping up training programs in that phase A will help you then afford the surplus, and then looking at more outsourcing. I mean, you guys just did just a fantastic job of talking about how to recalibrate your your cost structure. And I think it's something that a lot of people, I mean, what is the, like, when you think about how you all at ITR are viewing data and like the waves in your, it's like, I think about this one story, Brian. I was downhill mountain biking in New Zealand, and the trainer was like, if you look right in front of your wheel, you're totally screwed. Like, you're going to hit the brake and you're going to flip over your handles. You have to look 12 feet in front of you. Cause like by the time you see that, it's already happened.
Yeah,
And
yeah,
that's
yeah.
exactly. And by the way, one of my friends did that while we were, and he looked right at a Tiger.
Oh
And
no.
yeah, so I saw exactly what the warning was about. So like when you think about your, you have these different time cycles that you mentioned with different sectors and different leading indicators. If you were to kind of sum up like with the masses, with like, especially with the news headlines that you and I were alluding to last call of how ridiculous most of them are with the clickbait, what is the lag of like what people are viewing versus what's happening? I mean, is there kind of like an aggregate like index of like how like the masses, are they like 12, 18 months behind, or
Yeah. Anywhere from 7 to 18 months behind.
that
Yes.
makes sense. That makes sense.
It's not a nice, neat number. Um, and the leading indicators, and you've mentioned them, they're going to start getting confusing, I think, to people because there are some, like our ITR leading indicator, that is beginning to make a motion toward rise. There's the conference board; they have their leading indicators making some rise. That has some people saying, smart people, well, maybe there isn't going to be a recession. And I think that ignores all the other evidence for the sake of those leading indicators. And what they're not doing is the probability analysis. See, when we start to get a hook in the leading indicators, we jump on it and we say, well, that has a 37% probability of actually holding. We
Mm,
need 2 more months worth of data before we can assign, yeah, that's a righteous turn. And that's still going to give people a 6 month heads up
yep.
without giving them any false hope based on
Mm-hmm.
these. One of our own internal leading indicators, the optimizer leading indicator, did just that. And that's how we know it's going to happen to some of these other indicators. It went up for 2, maybe 3 months, and then it did a header back down. So,
Just to keep everybody on their toes.
yeah.
It's like the Groundhog's Day.
Yeah. So there it is. And that optimizer leading indicator leads all the other leading indicators.
Got it.
So it's a really good one of these where you can tell where the wind is blowing long before anybody
Yeah.
else is looking at the flag.
Well, and there's two to keep us within the time. Two kind of final thoughts or questions. One is the example you guys were given in your little. I think it was one of your. I don't know if it was the Trend Talks, but like the 7-minute thing on Spotify. You were talking about backlog, and I thought it was a wonderful way, or a very interesting way that I think the listeners should start to get used to. Of you know, of your backlog, how much of the future is it? There was some way of how you guys worded that. You want to just talk about, because has to do with making decisions based on this data of like, hey, this backlog, are you cannibalizing your future, or like, I don't know exactly how you know
Well,
what I'm.
yeah, it plays out differently for different industries, different companies, but it can cannibalize your own future because people were placing these large orders, right? Because the supply chain was shot. Now the supply chain is back. And what we're seeing is the backlog is officially there, but we're hearing customers are saying, I'm not going to take that this quarter. The order is good. I'm going to take it,
Got
Brian,
it.
but not this quarter.
Yep.
Down the road, we're going to
Yeah.
take it. And for some companies, they're very good about identifying whether that's a committed order or that was just a bloated order because of
Mm-hmm.
the supply chain issues. And that's really good conversation to have with your customers to find out how much of that is real and how much of it
Oh,
is likely
I've
going to
managed a fleet
go
of
away.
salespeople, Brian. I don't know
Yeah.
like, oh, that's good. That's good. Yeah. You got to you got to really care about your cash flow to really get to the answer to that question.
Yeah, you absolutely do. And I know we don't have time for it today, but next time, ask me why I think or we think China's best days are behind it and why they're the biggest global threat we have over the next 10 years.
Ooh, that's a wonderful, wonderful launching off point. Do we have time for one last question?
Sure.
And it's just more of a short one. I was curious, like as I was refreshing myself with the book, and like again, like I said when we started, the fact that you haven't lost your mind is ridiculously a tribute to you, because I mean in 2014 you guys were calling all this stuff, and but like with how janky the $5 trillion.
What does
What's
janky mean?
I
I
don't
don't
know.
even know.
I'm just thinking about like how wonky, janky. I don't even know what the right adjective over the last 3 years of the supply chain issues, all of this stuff, right? If does that impact the timeline of the 2030? I mean, because I know that's primarily demographics that is kind of driving that big, huge thing, plus along a lot of the benefits that the country has. Maybe we can pick this up with the China conversation, but I'm just kind of curious, kind of getting caught up
Yeah.
and refreshed if like
We
there's
we
a
we looked into that very deeply, Alan and I and Jackie. Um, the answer is no. It doesn't change the timeline
okay.
because of the demographics are what they are. We thought maybe because the country went into so much more debt, maybe
Mm-hmm.
that would change the timeline, but no, it doesn't. As long as you win the ugly dog contest on the planet, then you can get away with it. So.
I love it. Cool. Well, I want to respect your time. Thank you so much, Brian. I am looking forward, and I'm sure the audience is, to the answer and some of the commentary behind that last China comment. But thank you so much for your time, and I appreciate it very much.
Brian, it's always great to see you. Thanks for having me on. Take care.
I hope you're enjoying this episode so far. I love talking to Brian. I seriously wish I could trap him in a corner and just talk to him for an entire day or week. But I can't do that. So what I recommend you do is go check out the ITR economic updates. The links below. You can sign up for their newsletter, get updates on their 2030 Great Depression, their methodology, their trends talk. Go get the book Prosperity in the Age of Decline. Seriously, it's amazing. So thank you everybody for tuning in. And also just a note too, is if you're not subscribed to the Arcona Intentional Growth weekly emails, what we're going to be doing is we're actually going to be baking a lot more value into that newsletter. So it's not just an update on the podcast. We're going to be putting a lot more content into the quarterly economic and M&A updates, and then also rolling that into the weekly updates here pretty soon. But we're going to have resources that we are pulling from the Intentional Growth Academy, as well as other resources from people like ITR Economics or Butcher Joseph, who is willing to aggregate some data and give us some information that is also tangible and written, or links that is in the newsletter. So if you're not subscribed to the Intentional Growth newsletter, also go in and do that. So 2 takeaways: sign up for the ITR Economic updates, as well as the Intentional Growth newsletter that is going to be having more of this material into the newsletter as well. Thanks everybody for tuning in, and I will let you roll right back into the rest of the interview. Jeff, how are you, sir?
Great, Ryan. How are you today?
I'm doing good. And I was saying, here we are again. I like the fact that these are quarterly, because I think any earlier would be too much. So
Yeah.
the good news is we got a handful of things that have transpired since our last discussion. Something to do with the banking world, and the interest rates are still going up, and what's that doing to the M&A market? So in no particular order, is there any place that you want to start? Because I know last time we talked about like strategics and private equity firms kind of getting in the same level of their appetite and the kind of the valuations. Things had kind of changed around a little bit from the debt to equity ratios and earnouts, but I don't know if you want to start there, or any particular place you want to start.
Yeah, we can start. We can start there. I think since we last spoke, the Fed raised rates another 25 basis points. So I think the velocity of the interest rate changes have slowed a little bit, and as a result, I don't know that we have quite as much of a drastic change in just sort of the pricing environment in the last several months, as maybe was the case when throughout the course of 22, when we saw a much larger rate of change with the Fed raising interest rates over 425 basis points in a 12
I mean,
month
I've
period.
seen that chart, Jeff, where it's like when Volcker was doing it and all the different times, and then there's the one right now where it's just like straight up cliff, pretty much, of how fast they did it.
Yeah, exactly. It's amazing just to kind of see that how quickly that rate of change happened. So I think in the last 3 months or so, it's been a little bit of a slower pace of progression. Obviously, there's continuing interest in what the Fed will do going forward and how much they might continue to raise rates, or maybe if they take a pause. I think at this point, it's given the universe of buyers an opportunity to sort of recalibrate and kind of rethink the way they're approaching value in the way that they might be structuring transactions. Obviously the credit markets are a big part of the ability to finance those transactions, and I think we've seen a continuation of what we talked about last time, which really is, with these elevated rates of interest and potential recessionary conditions on the horizon, you have a lot of lending institutions that are being very cautious about the credits and how much capital they're willing to provide. Obviously, looking very closely at the cash flows of underlying businesses and really sort of doing diligence around downside scenarios and how much cushion there might be for earnings to deteriorate before covenants become an issue and you start to have companies bump up against covenant defaults, and it becomes a concern for the banks, of course. So that all very much continues at a very much an active, I'd say, active level.
So which it's interesting, and given the fact, so I'm out of pure curiosity for myself, when I look at what happened with Silicon Valley Bank, Jeff, of the mismatch of the long-term holding versus the liquidity that they needed, and like how just with the rates, I mean, like you now have the government, and like that is a true bottom of the rate of return of what, the 5% coupon rate now, or whatever the heck it is. So like now how that's increasing the returns that everybody else needs on these other types of assets as the asset risk pool goes up. When I look at commercial real estate and the mismatch potentially of some of these banks that are holding the loans, or the real estate investors that have levered their equity up, and the pricing is now in flux with the revenue, and then you have the private equity markets that are and maybe I'm incorrectly thinking about this, Jeff, but like the math equations are the same, right? Because each one of those are just different asset classes that have debt underneath them. And as the treasury floor is there, like we're not seeing a ripple effect in commercial real estate just yet, other than the refinancing wave that's coming on and the repricing. But how is that impacting private equity, the rates of return, the underwriting? I mean, is that having an impact on the conversations behind the scenes?
Yeah, certainly. You can cover a number of different things there. I mean, I think, generally speaking, the rising interest rate environment and the availability of credit, in borrowing is certainly having an impact on, the private equity return profiles, because to be able to, for a lot of these private equity firms to be able to continue to pay certain, elevated levels of pricing, that means they'd have to come to a transaction with a larger equity position to be able to support that level of value, and obviously that might suggest you're going to have a little bit lesser of a return profile if you have a little bit more equity in a transaction and less debt. So in order to maintain the same type of return profile that private equities typically try to target, it likely is going to mean that if you can't get any additional amounts of bank financing or debt financing on a company's balance sheet to support a transaction, and you don't want to put in any more equity, then you're going to be talking about prices for that particular asset coming down. And so that certainly creates an interesting dynamic, and in the sense that you've got a kind of a wider bid-ask spread, for lack of a better term, between the value that sellers are hoping to get for their asset relative to the price buyers are willing to pay for their asset, for that asset. And so, that in and of itself can create a little bit of a slowdown in deal flow, just because you've got this dislocation between what sellers are willing to accept and what buyers can or are willing to pay. And hopefully what we'll see over time is, seller expectations can either sort of be recalibrated to the new environment that we're living in, or there can be more creative deal structures used to help support that valuation gap. And I think there is a potential for that. And we talked a little bit about earnouts in the past as certainly one way to do it. I think there's a opportunity for buyers of businesses to find capital providers that are willing to be a little bit more flexible in terms of the types of amortization schedules that might be used on in the debt that's used to support a transaction. So instead of front end loading a lot of principal payments, maybe you can back end load some principal
Okay.
payments, or maybe instead of having current cash pay interest on a loan, you can have something like a PIK structure, payment in kind, which just allows for some of those payments to get deferred a little further into the future. In the event, obviously, you need to do something that would help from the perspective of managing potential downside and cash flows, or ways to sort of bridge value gap. There's I think a number of different opportunities to think creatively to try and come up with a solution.
Okay, so I love it. Thank you very much for framing that up well. And after I dished you a bunch of stuff, so I wanted to throw it, and I don't have the numbers right in front of me, and I wish I would have. But so a friend of mine is an investor in a REIT, a real estate investment trust, and he got a letter, Jeff. And I thought there's just the how this investor broke down just the basic understanding. What you kind of getting at is the bid ask spread, and I'm going to refer it to real estate. I'm curious like how that reconciles with the conversation you just had, because it was fascinating to me. And they were saying like, hey, as a real estate investor, if we were going to sell our assets, like truly we need to, whatever the return, because they already talked about having a return that they promised, right? So they have to, when they're going to ask for a sale price, it's based on the promise that they gave. But on the buy side, what they were breaking down, and bear with me, is they were saying like, if there's $100 that they essentially as the investment, and that's the asset price, and the cap rate going back with the treasuries being like the 5%, like this has got to be like the buyer has to have a 7.5% cap rate or whatever it was in order to make any of it make sense. Where if they buy it below that, they're immediately wiping out their own equity because they can't sell it. So there was just this kind of like natural floor in there. So therefore there was this whole conundrum of like the seller needs a return that they can't get because of the floor. And like, and how I think about private equity or just any kind of investment in a business, you have the private equity firms that need that return, just like that real estate investment trust. But then the founders who are just trying to make generational wealth don't necessarily, they've got a little bit more flexibility. I think maybe the overarching, is this in parallel universe? I mean, is that the kind of the same conundrum?
Yeah, absolutely. No, I mean, you're exactly right. With private equity have, portfolios of companies at some point they need to monetize, right? They need to find an exit for those. And you're right. Maybe they bought those portfolio companies 3, 4, 5 years ago, and they went into that transaction with a certain, return profile that they expected, and underwrote the transaction to that return profile. And now as we sit here today and they're trying to exit, if the values are below what they originally sort of anticipated and underwrote to, then you're right. They're not going to ultimately, at the end of the day, realize the type of return profile that maybe they originally were anticipating. And that, that might mean either they don't transact today, they don't monetize that investment today, they wait till, they wait a few more years for that exit event. Or they just, take a lower rate of return because they have to monetize that investment, return capital to their limited investors or limited partners. And it does create a little bit of a challenge and a conundrum for sure. Absolutely. Founder owners, to your point, I think that's a different, sort of cohort of business owners that might be transacting for different reasons. The founder owners, might be looking to exit because they're older. Maybe, they're at the point in their lives where they don't have the next generation of family member that wants to take over the business. We see a lot of third generation, maybe even sometimes some fourth generation families where that third and fourth generation, they don't really have an interest in continuing to run the family business, right? They have other career aspirations, and there's a lot of different career paths available to people these days. And so that group of business owners, I think, despite the environment we are in currently, are more likely to say, well, despite where we are, I still want to transact because what's motivating me to sell my business, my asset, is something different than just pure financial return profile.
Does that probably would make some sense to me that would be a good thing for buyers out there, because if the PE firms are stuck where they can't sell or it's slowing down the deal volume, would that be good for more of the founder-led cohort because there's potentially some more buyers given the age and the demographics and stuff?
Yeah, I mean, exactly. I mean, no mistake. I mean, there's still a lot of capital out there, right? I mean, there's still a lot of dry powder that investors need to put to work, whether it's held by private equity firms or even like we spoke about last time, strategic companies, right? Operating businesses. They have strong balance sheets coming out of, 2021 and in the early part of 22. And so they themselves have strong balance sheets. They have a lot of dry powder and I think that's an opportunity for founder owners to find buyers. It's a good opportunity for private equity and strategics to look at that universe of companies because there are some founder owners that are willing to transact and want to transact. And with all that money out there, people are still looking for good, high quality assets. So I think there's opportunities to put money to work.
And kind of in that vein, when you look at strategics, private equity, and I know you guys at Butcher Joseph do ESOPs as well, and they're a big player in that. So when you're looking at like valuations, deal structures, and net proceeds, kind of like in those three categories of enterprise value, how the deal structure is working, and then the net proceeds, is there any shifting as far as how these different types of buyers are comparing against those different levers?
Yeah, for a while, private equity was paying, really high prices, and it was hard for a lot of the other buyers to compete with what what they could receive if a private equity firm approached them with some really attractive offer. I think with private equity coming down a little bit on the prices they're willing to pay, as we talked about before, strategics are becoming again more competitive. And even the ESOP structure is becoming really competitive again. And I think as we've talked about in other, instances, there's some really advantageous tax benefits to selling shareholders to sell to an ESOP that allow them to potentially defer capital gains on the sale of their business if they sell to an ESOP. And as a result, when you think about the net proceeds now, you might find that, hey, you could really not only have a competitive type of scenario where with private equity and strategics, if you're selling to an ESOP, but it actually might be the more lucrative route to pursue with the net tax, savings available to you. So it is an interesting dynamic that we're kind of seeing that the ESOP structure is kind of becoming more in vogue again.
Yeah, that sounds awesome. Yeah. Oh, and it's interesting that the playing field is becoming a little bit more level on these different structures. How are the interest rates and the interest rate environment impacting seller notes on any kind of third party sale or the ESOP sale? Are the coupon rates going up, I'm assuming, along with everything else?
Yeah, so you would think, right? You would think that would follow with the senior banks. If the senior banks are raising their interest rates, you would think it would reverberate all the way down to the lowest part of the capital stack. But the thing is, remember, there's only so much leverage you can put on a business and have its cash flow supported. So if the senior banks are getting an elevated rate of interest and a larger percentage of the cash flows because the interest costs are going up, it leaves a little less for some of the people behind them, right? So you might see some increase, but it's not to the same degree.
Yeah, you can't have like a 7% coupon or 10% coupon rate and then an 18%. Yeah, exactly.
If the senior banks go up, 6, 7, 8, 9, whatever, you can't have the same type of increase in the cost of capital that comes behind it. So,
but also to your point, that's where if you're not paying any taxes once the ESOP's in place, you might have more wiggle room for the different capital structure to make everybody's ends meet.
Yeah, exactly. And that's where other types of creative type of structured equity structures come into play. I mean, you can have these seller notes that might be accompanied with warrants. So that allows you to have, warrants is oftentimes used as a tool to replace a rate of interest. And so you can kind of keep the interest rate low, which reduces fixed charges. If you have some warrants associated with.
Would you mind breaking those down? We've done quite a few on those in the ESOP miniseries and stuff like that we've done, but I think warrants could always get more attention because it's a unique and it has the potential to align a lot of the stakeholders.
It does. Absolutely. I mean, it's basically a deferred variable interest rate. Instead of being a fixed rate of interest, it's going to be, a variable rate that's dependent upon the financial performance of the business. And it's going to be deferred until a later point in time. when the warrant can be monetized at some point. So there is definitely an alignment with the ability of the company to afford to pay out the warrants and the value of the warrants. If the company doesn't perform, you might not have that much value in the warrants. And if the company performs really, really well, yeah, the warrants could be worth a lot of value. But at the same time, it's because the company did well and it can afford to now monetize those warrants because of its strength of cash flows and strength of its balance sheet.
What I think is such a unique opportunity is because, I mean, it's essentially kind of like rolled equity because a lot of times that variable is tied to the value, right? And you're not having a cash outlay for that.
Correct.
So like,
Yeah.
are you see warrants involved in third party deals or PE deals, or is it mainly like the ESOP structure?
It's definitely prevalent in the ESOP structure, but it's not unique to the ESOP structure, and it wasn't invented in the ESOP structure. It was originated outside the ESOP structure in general, M&A corporate, M&A environment, and so we do see it. It is common for non-ESOP transactions to have some potential structured equity. I think we're going to see more of it. We've certainly, I think, seen an increased uptick of its usage for the reasons I just stated in this elevated, cost of capital environment and potential for company earnings to maybe be compressed if we're looking out in the future with the potential recession that people continuously talk about. That you got to be prudent and think about.
On this note of just kind of the environment, and I know we're recording this before. What is it? 8 days before our politicians can actually have a good conversation with each other, like all joking aside, like, so this whole debt ceiling, we don't have to get into the major politics of it, Jeff, but like, I think more of the lens of what, obviously we're showing again that we can't get our crap together, but also that like the US's credit rating is tied to this, which ripples through all of this. Do you like, knowing that we don't know exactly how this is all going to unfold to everybody listening, and we've recorded this prior to any kind of outcome, but like, what are your overall thoughts on like how how these games impact the credit markets and the valuation in the worlds that you live in?
Well, obviously, it creates a lot of noise for one. I think there's a lot of popular press that speaks to the uncertainty of what might likely happen, and there's probably some politicking involved by legislators around using this kind of as a tool to try to extract other sort of things and have other motivations sort of attached to it. I mean, clearly, if the U.S. was to default on its debt, that would change the whole perspective of the creditworthiness of United States debt and treasury obligations, and would have profound ripple effects on credit markets and value, because it would sort of reset the risk profile for a lot of things.
At the foundational level. I mean, when you get the build up methodology, like, because I mean, in our training at the Intentional Growth Academy, when I'm explaining WAC, and it's like the risk-free rate, and then and now I'm like, every time I teach that, Jeff, I'm like, I always like hold the jokes, and so like I have to like acknowledge that like this is the build up methodology, but like we have this white elephant in the room.
Yeah. I mean, just think, if you have to start talking about, in those conversations, you start with the risk-free rate, and then someone says, well, what do you mean it's risk-free? Define risk-free.
Yeah, right.
Who knows? Right. There are some elements of risk there.
Well, it's good to know that, like, and I think if there's any reassurance that I have in that, it's like, it's so detrimental that, like, I mean, it's kind of one of those things where everybody listening, and I hope when we're ported into the future that everything's just fine. Right. And it's, how about, I'm trying to think if there's, normally anything in the tax world. I know there was some tax conversations. I think the carried interest got pulled out recently. Anything worthy of noting or keeping an eye on for our next conversation?
Yeah, I mean, there's still some talk about the corporate tax rate at the federal level. You were well aware that several years ago, the government lowered those corporate tax rates to 21%, and there's some dialogue about maybe that going up a little bit. So we'll obviously have to keep an eye on that. obviously there's a new, potential. There's a presidential election coming up, and could potentially have the same or a different administration. So we'll be watching that, I think, closely, but it's probably a little too early to tell maybe where that's going to go at this juncture. But it's certainly something that I think, as you think through the federal government and budgets and debt ceilings and all that, is clearly becomes a topic of conversation, and maybe an area where certain legislators look to maybe increase that back up to help in other areas of buckets of.
Definitely going to be, whether like however those conversations are going to be happening, my guess is there's going to be a lot of mudslinging both sides. One question I had for you, Jeff, is like, because like both parties keep throwing this carried interest, where they want to get the carried interest out, but then they want to eliminate it, but then it always gets pulled out at the last second. I was going to ask you, like, so if you have a PE firm, which there's obviously tens of, 14,000 or whatever it is right now, where they wrote this investment thesis, they raised the money, they're buying these companies under this model, would it, like, at any given point, like, would it change everything in that current moment? I was always curious of like, if that law got passed for some reason, would it impact all the PE firms going forward? So like when they were to monetize or sell or anything, like would it immediately change? Because I could think about it, like interest rate environment, all these things we've talked about, there's downward pressure, and that could totally blow up the IRR models that these people have. I'm just kind of curious about your thoughts.
I think those carried interest provisions are really more closely tied to the general partner and the taxes to the GP, and so that's going to be a little bit more of a personal tax implication,
not towards the LPs. Got it.
Yeah, a little bit, I think, slightly different there. And obviously, I think when you're talking about the underlying businesses that are being invested in, obviously there's still some tax leakages for each one of those businesses at the corporate tax level, right? So a lot of that comes into play more so than some of the carried interest stuff, as you're talking about the underlying investment itself.
Got it. I'm trying to think. We covered some good ground so far. Is there anything that I haven't asked that I should?
You mentioned a couple things that I know that we dug too deep into. I mean, clearly, you mentioned commercial real estate at one point, and I think we're just at the infancy stages of kind of seeing some of the ripple effects of how that's going to play out, because not only are interest rates going up, and so refinancings are happening at different types of cost of financing than maybe anybody anticipated. But I think that's an area that is going to be interesting to watch, just because of the way businesses and employees are working today.
The revenue, like you said, the refi is increasing the cost structure, but then the revenues aren't even there, so the valuations have to be readjusted.
Yeah, we work with a lot of companies that are saying that they're actively revisiting their office footprint, and some of them have already been really proactive at shrinking that office footprint. And so, that's something to keep an eye on and see how that reverberates through the economy, and what that might mean, for investors, and that could have some serious implications, I think, for a lot of folks that are really heavily concentrated on office type of commercial real estate.
There's that, and then the banks that hold those notes, man.
Yeah, and that's the other thing. Exactly, is where I was going to segue. Is you touched a little bit on Silicon Valley Bank, and that was obviously a unique circumstance with type of.
I think Brian actually said, "Poor strategy with poor management executed perfectly," or something along the lines like that.
Yeah, the perfect storm. But what it has done is obviously drawn a light on that universe of lenders, the regional banks, and I think it's given a lot of companies a moment of pause to make sure that if you have a credit partner that's a regional bank, you really understand the exposure of that regional bank, and so
call out.
Not that everybody's running to the exits and removing deposits at the corporate level. I think you hear a lot of that maybe at the personal level, people pulling individual deposits out and moving it over to the large money center banks. But certainly at the corporate level, I think companies are looking at those regional banks to make sure, they understand who the partner is, and that they have a level of comfort about the ability of that partner to continue to be able to support their business on a go forward basis, particularly if you are an organization that wants to be, not only managing your working capital and you need the bank for treasury functions, but you want to be active at making acquisitions, right? Is this capital provider going to be there to help you with providing the capital you need to go out and make those acquisitions of businesses when you want to? And if not, or if you have concerns about that, then you need to start. A lot of companies are thinking about, well, maybe we need to start thinking about establishing relationships, secondary relationships now, so that our ability to make acquisitions and to get the capital in the future when we want to make those acquisitions isn't precluded, by the single relationship we currently have.
Yeah, and such an amazing call out, Jeff, and that's for growth, right? And I, honestly, man, I don't know if you and I've dove into this, but this is so hitting home, because in 2009, when I started in our family business, when we were doing 21 million, our bank had an FDIC covenant because they had a bunch of shit loans from 09, 08, 07, 08, 09, all that stuff. And they were forced to get rid of this division and this holding, which our business was in. So they came in and said, we want you out, but they were making so much. We were financing our receivables. There was a lot of, this is why I'm so passionate about all these topics, but all of a sudden, it was a ripple effect where we had a good business, but we had no control over that. And they were like, well, we want you out. And we're like, well, they'd already sold their SBA loan. So they were servicing, collecting the fees. They wouldn't refinance us. All the other banks were puckered up. And we're like, we have 50% margins on our service contracts. We have all this, but they were not willing to help because of their own circumstances that directly impacted us.
Right.
And I just I want to exclamation point, highlight, underline everything you said, because not only for growth, but like you said, working capital, your line of credit, all this stuff, you're right. I mean, what is your thoughts about entrepreneurs? I've always, because of my experience and the people I talk to that aren't from finance that are entrepreneurs, they always found a hesitation to ask the bank about their holdings, because it's the voodoo behind the scenes. But what is your suggestions on how to have that conversation?
That's a great question. I mean, I think hopefully that entrepreneurs have some sort of relationship with the banker, that they can feel comfortable with this banker asking them some pointed questions. Whether or not that that bank will be willing to share a lot of information is a different story.
Willing or understands or knows, right?
Yeah, exactly. I mean, but I think it's an important question to ask. I think it's a valid question because of the great example that you made. I mean, here, your business is performing. You need capital, and the partner that you've aligned yourself with is creating some complexities that are sort of outside of your control. And so, I would encourage the entrepreneurs to certainly ask the question. Just continue to hopefully make sure that if you're getting good, straightforward answers, great. And if you don't feel like you are, then it's okay to have conversations with other institutions to protect yourself in the event you need to pivot quickly.
Right, and there's your answer. If you're not getting good answers or they're being weird about it, there's your answer that maybe you should start having.
Trust your gut a little bit, right? What are they telling me here? Why?
Yeah, right.
I feel like I'm getting a good answer.
Awesome, man. Last question for you is anything that we should be thinking about between now and our next conversation? Anything that you're paying attention to that would be worth kind of picking up the thread when we talk next?
We're watching, I think, a little bit at this point about what's going to happen throughout the rest of the year with a lot of our clients on the margin side of the equation. I think that, as we talked about in prior instances, as supply chains tighten, as inflation sort of reared its ugly head, as the cost of raw materials went up, as the cost of labor went up, a lot of companies really didn't have much of a challenge in pushing through a lot of those cost increases to the end user, their customers. I think we're seeing some companies recognize that maybe they have to be a little bit mindful of how far you can push some of that. And I think that if to the extent inflation continues to increase or maintain its elevated level and you can't pass through those cost increases, we'll see some margin pressure. I think we have seen some, raw materials costs kind of come down a little bit from the elevated levels. We're understanding that from talking to some of the companies that we work with that, they're starting to see some moderation in the labor cost of labor.
Okay.
It's sort of stabilized a little bit, so that kind of helps. So we're kind of watching that just to kind of see, what that might mean on margins on a go forward basis. So we're curious to see how that'll play out over the course of the next quarter, because the demand, at least at this point, seems to still be there. A lot of our companies continue to express, that backlogs at record levels. The demand side of the equation is strong, but they're watching kind of the margin pressures a little bit still, because they're
Okay.
worried about the ability to continue to to kind of sustain the types of margins that they're coming out of in 22.
Super helpful, man. And that layers right into when Brian and I were chatting about the labor cost, because like this is the inflation went from the flash in the pan to, hey, this is more of a sticky inflation with where it's tied to labor. And in the prosperity and the age of decline, when Brian and Alan were talking about, like, when you're doing the cost of living increases and like you can essentially never catch up to that. So
Right.
kind of watching that. What I also was kind of curious is how will the demand continue on all these sectors. So I think it's a great place to keep an eye on. We'll make sure to pick those back up.
We will.
Hey, Jeff, this is a pleasure. I appreciate everybody at your team and your guys' willingness to do this. I appreciate it. I think the listeners do as well. So thank you very much.
My pleasure. Thanks for having me. Great to see you again.
Yeah, talk soon.
Okay, you bet. Take care.
John, how are you, my friend?
Good, Ryan. How are you?
I'm very excited to have this conversation. I'm very good. And I always enjoy our conversations because, like you just get it, man. I don't know what else to say. I enjoy our conversations because they zig and zag, but it always is fun. And you've got a lot of experience. For the listeners in, he's got SBA guy over his shoulder right now with his old license plate. Yeah. So John's done a couple deals in his past, but John, why don't you just give us the listeners a little bit of your background, and then the bank that you're at, and then we'll set the stage to some of the changes coming up down the pipe.
You bet, Ryan. So my nickname is the SBA guy. The name is John Thwig. If you think of the sound a bow and arrow makes, you'll get it just right. Thwig. I've been in banking about 34 years, been doing SBA lending about 21. My primary focus in SBA is M&A. So mergers, acquisitions, basically what SBA refers to as change of ownership. And the thing that gets me out of bed every morning is helping change people's lives. Most of my clients are individuals who are non-owners. They're going to become owners. And that remains really, really fun. Booking another loan, yeah, that's part of the process, but that's not the exciting part. The exciting part is that life-changing event for both the buyer and the seller. Lots of fun, lots of interesting businesses. I spend most of my day looking at financial packages, trying to figure out what I can do on the sell side, and on the buy side, getting to know buyers.
And I want to, sorry, one comment there, John, is like after working with you in various, conversations or looking at deals over the past, you had mentioned something in one of our conversations. You said like, because you know a lot about M&A, right? But then you had said something in the past, John, in one of our conversations that you chose SBA as the tool. So you understand the landscape, but you're very good at understanding where you and the tool fit. I just thought that was interesting context.
Yeah, the important thing to keep in mind is in this landscape or ecosystem, SBA is one flavor of capital. And that's the term that I like, flavor of capital. Each flavor of capital has pros and cons and may or may not be a fit for any given transaction, either the seller, the buyer, the business dynamics, whatever it may be. And SBA falls into the world, of course, of debt. So I go, capital comes in two primary forms, equity and debt. In the debt world, I would be one of the flavors of debt. And I believe in specialization. That's hence the nickname. I have great expertise in SBA debt. I do not have great expertise in private equity, for instance. I'm certainly familiar with it and aware of it, understand some of the dynamics, but it's a very different source of capital. So I do kind of stick to my lane and keep my expertise there.
I love it. And you found a new home recently. Why don't you just give us a little bit of the background of where you're at right now, and then kind of what the typical structure is of the SBA as what was the current flavor? Because when we talk about how the flavors maybe changed a little bit.
Yes. So I am at Live Oak Bank. Live Oak Bank has been the number one SBA lender in the country by dollar volume last 5 years. And in the industry that I'm in and my specialty, Live Oak has what I call a gravitational pull. So I spent 28 years at Wells Fargo. That's where I really grew up in my SBA career. spent a few years at a regional and local bank, but have known Live Oak and the folks at Live Oak for a long time. And Live Oak is the only bank in the country that is really dedicated to and driven by the SBA 7A loan program. It was really the primary mission of the bank from its origination. So it's when you're an SBA specialist like me, being at a bank where SBA is normal and not weird, it's really nice.
And I had mentioned before we hit record that, you know, Live Oak, for what I gather, they're progressive and innovative enough where they're working with like family office or wealthy individuals and pairing them up with like the acquisition entrepreneur space, which I know you play a lot in. You didn't say that phrase, but our friend Walker Dybel kind of coined the term, and really trying to get deals done. And whether if it gets outside the SBA or if there's other capital that can be involved, you guys are helping people actually just get the deals done.
Yeah, we are certainly an SBA driven lender. But yes, M&A is our space. We look across, all kinds of industries. We have a very active searcher group. So that's a very active part of our practice. We also have, Live Oak has a dual strategy in the marketplace. We have what we call vertical lenders that specialize and have expertise in a particular industry, and they lend nationally in that industry. And then we have folks like myself. I'm a generalist. I have a little bit of a geographic focus. I'm here in the Twin Cities, but I can lend nationally, and my focus is M&A. So in that space, we have a team of about 38 lenders that are generalists and lending across industries. So we have both a vertical and a horizontal over it with us generalist lenders.
Awesome. So let's set the stage, because we're going to be talking about what's at the forefront of potential to change. But why don't you just give us the general framework, John, just to get everybody on the same page of SBA's kind of the constraints, the typical, up and down the checklist of how they work and where they fit from, and then we can go into what might be changing.
Yep. So we'll talk a little bit about SBA overall, but one important thing to know, I think of buyers in terms of what's their kind of profile. My buyers are what I call people. So in other words, my buyer is not necessarily an entity or an organization or a fund. It's a person. It's somebody who may be, for instance, a corporate refugee. They've had a long, successful corporate career. They now want to own before their career sunsets. It may be an entrepreneur who has owned businesses before, or it may be an entrepreneur who owns a current business but wants to expand. My business is typically a person. For instance, in private equity, the buyer is a fund, might have a sponsor, might be the fund itself. The buyer is an organization. In strategic, the buyer is an organization. Now, some of those strategics I can fund with SBA. Some strategics might not need me. Strategic being, i.e., a business that's going to buy a similar or complementary business.
That'll generally get, because they get either the size is too big, or they can leverage a conventional loan because of the cash flow that they got, et cetera.
Yeah.
Got it.
Based on their balance sheet and strength, some strategics are going to look at me and my solution and go, "Oh, we don't need that guy." So the key is, does the source of capital fit the buyer's needs? Now, some of the changes that are going on in SBA SOP, or standard operating procedures, are going to liberalize a little bit of that. So SBA might be a fit more often than it was previously. One other thing to keep in mind, important thing to keep in mind with an SBA loan, unless it's an ESOP where there's no owners over 20%, an SBA loan is always going to require a personal guarantor. And that's where private equity funds and some strategics, they say, no, we really want non-recourse debt, recourse being a personal guarantee.
Oh, but personal guarantees aren't in the hit list for a PE firm.
So in the SBA world, that's, I would say that's a first call conversation. By the way, we're going to have your unlimited personal guarantee. If it's more than one owner, going to be joint and several guarantee. And that guarantee may be collateralized with a lien on a home, for instance. So that does make it a different form of capital, but it makes it a great one for people who want to buy. And I can also lend at higher leverage than, for instance, senior debt on a PE deal would. So SBA has the downside of the guarantee, but it has some upside as well. And in terms of size, SBA maximum is $5 million for a specific borrower or affiliated borrowers. But that doesn't mean the transaction's deal size is limited to $5 million. We often play in the $5 to $10 million range, and we're combining both SBA and conventional bank dollars via what is referred to as pari passu, or shared lien position or combination financing. So for me, that 3 million to 10 million enterprise value is really the target, driven by SBA, but often with conventional bank dollars in addition.
And the SBA loan has, at the current moment, has the change of ownership stipulation, and then correct, and then how much seller finance. You kind of want to give kind of like the kind of combo deal structure limitations kind of situation as far as what is ideal right now.
Sure, you bet. So some things are definitely changing, which is exciting. So SBA, Ryan, as you mentioned, an acquisition falls into what SBA refers to as a change of ownership. So in other words, the ownership of the small business enterprise is changing from one owner to another. There's always been quite a bit of regulation in the SBA standard operating procedures about how that happens. Some of that is changing pretty fundamentally. So for my entire SBA career, when an outside buyer is buying into a business, it has to be a 100% change of ownership. So that just changed here recently. Partial buy-ins are now allowed, which is a pretty seismic change in the SBA world. Now, figuring out how exactly lenders will adapt and adopt that's going to kind of be the trick. But the other thing to keep in mind, for instance, on that item, which is probably one of most interest, if a seller sells 50% of the business, they're still going to be required to personally guarantee, because that SBA rule of any owners of 20% or more will be required to personally guarantee. That rule is still in effect. So I don't think of the partial buy-in as a partial buy-in. I think of the partial buy-in likely as a 81% plus buy-in scenario, because most lenders are not going to want to personally guarantee their own liquidity of that.
So, yeah, because you would be getting some capital, but you're just, I mean, how is that any different than refinancing and pulling a bunch of cash out, right?
Well, it starts to look and feel a bit like a recapitalization.
Mm-hmm.
From my personal point of view, most folks in my world, when they're selling, their desire is to highly reduce or eliminate risk related to the ownership of the enterprise. If we fund somebody and they're still 20% or more ownership, and they're required to guarantee, they haven't really eliminated any risk or taken chips off the table, so to speak.
Mm-hmm. Wait, what I find fascinating about this opportunity, John, is that if in your world, and maybe this might be interesting as you observe your clientele potentially start to evolve a little bit too, because I mean, I just think about the partnership buyouts that I've personally been through. I still want to be doing this, but it would be nice to instead of finding someone that has a bunch of capital, they could come in and personally guarantee with me to grow together at the same time. So you kind of may change the design, maybe back to your point of the tool, it's fixing a couple of different other solutions out there or problems out there.
And this does solve one other big problem. Something that we've always struggled with in my world is articulating the transition. And for businesses that are larger or more complicated, articulating how a business would transition in 12 months was the old requirement. Right. SBA SOP previously required a seller to exit as an owner, officer, or key employee within 12 months. As an officer and owner, day of closing. So we always had to focus on 12-month transition periods. That requirement for the seller to exit is now gone. So suddenly the window is open that for businesses where the seller, their importance to the operation and or just their desires are to stay with the business for a period of time, that's now possible. Now, the one thing I do like to remind people is that SBA rule of, hey, if you're under 20%, you don't have to guarantee. Well, you don't have to, but a bank could also require it, even if you're less. So for instance, if I go to the bank with a business plan where the seller is still key to the ongoing operation and success of the business, but they're 19%, the bank could certainly still say, hey, that's great. By policy, you're not required to, but because of the credit dynamics, you are required to guarantee. So there's two parts of that story to tell.
That's good to know. And I think what for the listeners in too is, so John, we talk a lot about in the intentional growth framework is separating ownership from leadership. And the SBA up until this point was forcing both of those to be transacted and transitioned at the same time. So a lot of times I'm saying you have to separate those. However, the way that the policies work, even though they are different things, they were being forced to be done together, which I find such a great opening up of options, because like there are people that just want to take some chips off the table, but they might want to work part-time because they love it. They love their community, their people. And it's like, well, let them have a salary and work in the business if they want to. And what was the rationale before with that?
Well, I can explain what my interpretation was of it.
Yeah, I know you weren't at the design phase, but
but now with some of the new SOP, I go, was that a right interpretation? The way I've looked at it for my last 21 years is that was SBA's way of telling the marketplace SBA as a source of capital is really geared toward relatively simple, closely held businesses that can effectively transition in 12 months. I always say SBA is not saying, excuse me, that those other transactions aren't good deals. They're just saying, hey, SBA is not the right flavor of capital for a business that's going to need a 3-year transition, or that has other dynamics that complicate that picture. I always go, we like to boil it down to SBA's mission. From my point of view, SBA has 2 primary missions: to preserve the jobs of the primary entity that we're talking about, the small business enterprise, and to preserve the income tax basis that drives. So to me, SBA's policies always reflect that mission. Their mission isn't really to give a seller a liquidity event. It's to protect those jobs and that income tax stream. But I do think we're getting more creative ways to do that. And the other thing that I like to do is I like to give the business a seat at the table. Because a lot of times when I'm putting together a loan package, one of the questions I ask myself and the other participants is, what would the entity say about what we're doing?
I love it.
Does it make sense from the business's point of view? Is the leverage right? Is the working capital structure right? Is the ownership and management structure appropriate? How does the business feel about this? Or does the business go, hey, wait, you guys are putting me in a jam? Mm-hmm. That's a way I think that always helps clarify. Oh, then SBA policies kind of make more sense in that light.
So is when you're stacking an SBA with other forms of capital, do the same stipulations apply?
Yes. So SBA policies really always apply. Okay. So let's touch on one of the new policy items in SOP. And so it's now in SBA SOP, standard operating procedure, but banks are still trying to figure out, hey, what exactly will this look like? So SBA has changed the equity requirement so that seller financing used to have to be on 10-year standby to count as equity. And it could be a maximum of half of the 10% required equity. So you might have seen that out in the marketplace. A lot of people kind of advertise that 5 and 5% buyer cash, 5% seller financing on full standby for 10 years. That has now changed. So SBA has liberalized that standby period to 24 months. And SBA has also said, hey, if the business can support the debt with debt service coverage, and it's on interest only, seller financing on full standby can be up to 75% of the required equity of 10%. So in other words, in theory, a buyer could get in with 2.5% equity and 7.5% equity on 24-month standby, and there's your equity requirement. So the question becomes, you've got an overlay, you've got SBA SOP, you've got bank policy. Well, are banks really going to leverage deals at 97.5%?
Especially given the last few months and part of this quarterly update. I know we've already discussed Silicon Valley Bank quite a few times, so it'd be interesting to see what these bank policies are. Before we move on to then the bank policies, because I think this would be a good lead in, John, as far as like how are they going to be interpreting this and what is the process for them to actually consummate this?
Right.
Can you shed some light or just get everybody back up onto the same page as far as like you have a bank that does the underwriting, and then what is the relationship with the government in the SBA? Because I think that'll help give some insight as far as how they're interpreting this going forward.
You got it. So what I tell my clients is the way to think about it, US SBA is just a big insurance company. It's really all they are. So SBA isn't making the loan. The bank is making the loan. SBA isn't documenting the loan. The bank is documenting the loan. SBA isn't funding the loan. The bank is funding the loan. And this is specific to the SBA 7(a) program. So it's really a bank loan with an insurance policy from US SBA, and it's done with the characteristics and dynamics of SOP. And then the bank buys an insurance policy from US SBA, If there's a default and liquidation, that insurance, the bank goes back to USSBA to basically insure that loss, a portion of that loss, typically 75% for a standard SBA loan. So I always tell folks, even though I'm the SBA guy, I don't deal directly one-on-one with USSBA. Plenty of folks at the bank do, but my borrower doesn't, and I don't. And the key is, first of all, does the transaction make business sense? Will it make credit sense to the bank? And can we have it meet SBA policies?
Mm-hmm.
So people tend to worry too much about SBA or the SBA. Most good SBA lenders are preferred lenders. They're approving deals with their preferred lender authority. So we go to USSBA, we put everything into their system, we get a loan number back. We now have an SBA approval, but there's not a human on the other side looking at the deal and approving it unless you go GP, the general program. But through preferred lender, we're doing really all of that.
I mean, really, it's acting just like the, so in quotes here, the FDIC with the 250K, right? That's impacting the risk profile of the loans of the bank, right? So how they're underwriting, how they're taking their risks and putting the risk based on their portfolio, it's going to matter because then they can have their portfolio organized in a different way, given the fact that the SBA is backing that percentage of the loan.
Yeah, an SBA loan is essentially a credit enhancement that allows banks to put more capital into the market at better terms. And when I say better terms, I mean easier repayment for the borrower, being the company.
Mm-hmm.
When a bank has to fund goodwill conventionally, it'll often use a shorter amortization, 5 to 7 years, and it very well may want some collateral, either from the business or the owner or both. In the SBA world, I can fund a goodwill. I can take a service business where the purchase price is 100% goodwill. I can fund it on a 10-year term. And if there's collateral available, I need to take it. But if there isn't any and everything else works, I can still say yes. So SBA allows lenders to put more capital into the market on easier terms for borrowers.
And when I say that you get it, like when you and I first met years ago, John, I mean, you were funding these e-commerce and SaaS businesses where you're like, it's a domain and it's a thumbnail at closing. And it's like, yeah, it's a cash flowing asset. Like what a concept, right?
Yeah. And the, banks are good at understanding business models that can be replicated, where they have experience. I do sometimes get folks who have, if I'm on my third discussion of how does a business work and I still don't understand it, it's probably not a great SBA candidate. And I do see some of those. But even e-commerce, I go depending on the characteristics. Banks care a lot about, for instance, revenue streams. So whether you're a manufacturer with an 80% customer concentration with your primary client, or you're an e-commerce provider where you're 80, 90% through Amazon, well, those are both risks.
Mm-hmm.
Banks don't really like those kind of risks, but certainly e-commerce as a business model, hey, that works great. As long as you've got a diversified stream of revenue, we're going to like that. Same thing with manufacturing. Diversified customer base, we like it.
And what just before we move on, like highlight, exclamation point, underline, circle, because like what you could replace the word bank. Any investor wants it, right? It's sustainable, predictable, transferable cash flow into the future. And if we think it's goofy, it's probably goofy, right? I mean, it's just like, I'm happy that the world's kind of getting back to a little of the common sense that I think will do us all real good. So what now as we kind of go towards, when you say that you have the SBA SOP that's out, but now you have the banks, like you had just referred to, are now, they have to underwrite this stuff because they're the ones doing the deals, making the loans, even though the quote unquote insurance policy is backing that portion of it. So where is it at right now in this process? So the SOP came out. What's the conversation happening, and how should we be observing the going forward movement?
Great question. So a couple things to know. So first, there were some regulatory changes, kind of sequence of events. Then those regulatory changes became SOP, standard operating procedures, that just came out from USSBA here very recently. Now banks are interpreting those new SOPs. So again, it's the overlay, USSBA SOP, then banks put their overlay of their bank policy on top of that. So in other words, we got to find transactions that meet both.
Mm-hmm.
and banks won't always go to the exact right to SOP. And every bank's going to be a little different in terms of interpretation. So the key question is, to me, is the bank credible? Does it really understand SBA? How deep is its expertise? And how will it choose to interpret that? Because part of where the rubber meets the road is downstream. If you do an SBA loan and there is a default and the bank takes a loss 3 years from now, hey, how did we interpret that policy today? Because we're trying to use that insurance policy 3 years from now. So some of these things like the partial buy-in, I think the solution on that looks pretty straightforward. Mechanically, how's that going to work? How will it be documented? Some of that looks pretty straightforward. One of the other things that changed recently is affiliation. Affiliation conceptually used to be either via ownership or control. So in other words, if I owned a company and then you and I were partners in a company, were they affiliated? Before that was about both control and ownership. Now that's just about control. So for instance, that's going to have a big impact in the franchise industry. It used to be that all the franchisors had to be on the SBA registry if they wanted to be eligible for SBA funding for their franchisees. That's no longer the case. The SBA franchise registry we expect will go away. And now there is no affiliation via control. So franchisors and franchisees are not affiliated unless there's an ownership, or typically 51% ownership, in the structure.
Interesting.
So affiliation has gotten much clearer. Something else, most things got liberalized. One thing actually became more restrictive. The SBA 7A expansion program. In the expansion program, when we've got an existing or strategic operator, they're acquiring another business or they're expanding to another location. Previously, we've been able to finance those at 100% loan to value. In other words, we can finance the whole project with no equity. So a fair number of my acquisitions actually have no equity component at all because it's an expansion, as long as cash flow supports it. Important to know.
Yeah. Asterisks. Good footnote.
SBA did come back. Now, that's always been, we've always had to articulate that was an expansion of their existing business. But for instance, it could be a vertical integration. Now, SBA has made a more formal definition of expansion, and it has to be within the same NAICS code. It has to be with identical ownership, and it has to be in the same geographic area. So the expansion program actually got pulled back a little bit, where a lot of these other things have been a liberalization. So across all of these issues, banks are thinking hard about, hey, what does this mean? And how do we overlap this with our existing policy, with any proposed changes to our policy, and with the underlying concept that SBA always expects, which is that we make a prudent loan. Because that's the other thing I like to remind people. You can take all of these policies, and sometimes you can come up with something that really doesn't sound very smart. So the foundation this all lays on is the lender still has to prove to US SBA that they made a prudent loan. So that's
just to like go back to what I said earlier, John. Let's just all use our common sense, right? Like we need, and like I understand the expansion. Like, yeah, that might be restrictive for a good person with good common sense. But my guess is like, I mean, I'm sure over the last 3-4 years, you got people in manufacturing that are expanding into NFTs. Actually, I shouldn't have said that so loosey goosey because I actually have a client that actually did that with a really good business model because they're creating physical NFTs. But anyways, you get my point. But like, it's just layering the common sense that the cash flow has to service all of this and has to provide a return for everybody.
Yeah, it's one of those things where we've always had to articulate that it was related, not only related but closely related. But for instance, it didn't necessarily have to be the exact same NAICS code. Now it does. So some of that is saying, and some of that might be some feedback to the lending community to say, hey, when you're using expansion, we want you to make sure it's truly an expansion of the existing enterprise with the same ownership in the same geographic area.
Love it.
Yeah.
So as I know we're getting short here on time, I'm thinking, so use cases, John, I maybe we could tee this up for as this unfolds a little bit more, having you back on kind of like, hey, this is exactly how people are unfolding, this is how banks are seeing it. And these are the use cases that are popping up. But I mean, I could even see this being a huge game changer for the lower market, which is 95% of companies under 5 million in revenue, where the cash flow from operations could not service the SBA loan, pay the taxes and the owner. I mean, the whole math equation, you and I, when I was looking at buying a company years ago, it was like the numbers just don't work on any of these things. However, internal buyers, the executives, other people could come in, and there's actually a facilitation now that might mathematically work.
Correct. So to me, the partial buy-in is a significant change. It doesn't necessarily change some of the underlying fundamentals, but one of the things that for a lot of my what I call external buyouts, for instance, working capital creates a new burden on the business. Most of those in the market that I'm in are structured. Either they're structured where the bank is funding the working capital, or net working capital is negotiated into the deal. But if you've got a seller remaining, there's requirements around even if you may be able to leave existing debt in place. For instance, you may be able to leave. How's the working capital going to be treated? So, in terms of how do you creatively get to a solution that serves the interests of the seller, the buyer, the entity,
mm-hmm.
and hopefully the lender gets repaid with some interest. So I go the art of the deal, I think, has gotten a little more wiggle room, a little more elbow room for us folks to create solutions that people think are a good idea.
Awesome, John. This is super needed. I'm excited to see how the new flexibility comes in, because I mean, I think this is going to be good timing for the facilitation of 90% of the marketplace that needs to transition at some point. I definitely want to extend the invitation to come back on as you're understanding your Live Oak, but all the other banks, as you're hearing what's going on, what are the use cases, and then how are things actually getting done. I would love to have you back on, but the last question I have is where can people find you? What's the best place to reach out and to follow you?
You bet. I can be reached at john.twing@liveoak.bank.
Awesome, John.